Two people take out the same loan, same amount, same rate, same day. One of them makes money off it. The other one gets buried by it. The thing that decides which one you are isn't the size of the loan, and it isn't the interest rate. It's one bit of arithmetic, and it takes about 90 seconds to explain. A loan is renting money. That's all it is. You borrow an amount. You pay a fee for the time you've got it. You give it back. The interest rate is the rent. So the only question that matters is, does what you do with the money make more than the rent costs? If the money earns 7% and the rent is 4%, you just made 3% on money that was never yours. That gap has a name. It's called the spread. Then there's the second half, which is how many dollars you're controlling for every dollar of your own that you put in. That's leverage. Multiply the spread by the leverage and you get what you actually made on your own cash. That's the number. Spread times leverage. Every single one of the 6 things I'm about to show you is that one equation with different stuff plugged in. Some of them you can run this month with what you've already got. Some you can't yet. Because I'm not going to pretend a hedge fund's tax setup is a Saturday afternoon project, but you need to see the big ones to understand why the small ones work. Let's start with the oldest one there is. This is called trade credit. And almost every business that sells a physical thing runs on it. Say you fit kitchens. A job comes in at $18,000. The version most people picture is you buying the cabinets, the worktops, the sink, all of it out of your own pocket, doing the work, and getting paid at the end. Your money's tied up for 6 weeks. Nobody who's done it for a while operates like that. Here's the real version. You take a 50% deposit before you order anything. That's $9,000 in your account on day 1. Then you order materials on a supplier account, net 30, which means you get the stuff now and the bill lands in a month. $7,000 of materials you haven't paid for yet. You finish in 3 weeks, collect the other $9,000, and pay the supplier out of that. Say you clear $5,000 on the job. Now run the number. How much of your own money was in it? Not a dollar. You made $5,000 using none of your own cash, because the customer funded the start and the supplier funded the middle. The other channel that covered this said that makes your return infinite because you divided by 0. Not quite. Dividing by 0 doesn't give you infinity. It gives you nothing. The question stops having an answer, but what's underneath it is real. And it's better than infinite return. It's this: if you can run a job without your own money in it, then money isn't the thing limiting you. How many jobs you can sell is the thing limiting you. That's why selling is worth what everyone says it's worth. The kitchen fitter didn't need capital. He needed a deposit and 30 days. Mind. And you can do this one right now. Anyone who does work for people can. Take a deposit before you buy materials. Ask your supplier for terms. Invoice at the start of the month instead of the end. Every one of those takes your own money out of the deal, and there's a much bigger version of this coming near the end that uses a credit card. Real estate. This is the one where you can end up owning an asset you barely have any money in, and I want to run it properly because most videos skip the second half. You find a house at $320,000. It's rough, which is why it's cheap. You put 25% down, $80,000, and take a mortgage for the other $240,000. Then you spend $40,000 fixing it up, so your own money in this deal is $120,000. Now it's done, and it values at $430,000. You refinance at 75% of the new value, $322,500. That pays off the original $240,000 and leaves you $82,500. Take off about 3% in closing costs, and you walk away with roughly $73,000 in cash. So look at what just happened. You put in $120,000. You've got $73,000 back in your pocket, tax-free, because borrowed money isn't income. And you still own a $430,000 house with $107,000 of equity in it that somebody else is now paying the loan down on. You made $107,000 in equity, with $47,000 of your own money left in the deal. That's more than doubling your money, and you got most of your cash back to go and do it again. That's the whole reason investors are obsessed with this. Now the honest bit, because this is where deals die. Your payment went from about $1,585 a month to about $2,130 at today's rates, which are sitting near 7%, not the 6 you'll hear quoted. Add tax and insurance, call it $650. The house needs to bring in about $2,780 a month before you see a dollar. At $2,900 rent, you're clearing $120 a month, $1,400 a year, on $47,000 still in, 3%. So the cash flow is thin. The money here is in the equity and the loan getting paid down for you, not the monthly. And it only works at all if you buy cheap enough that the rent covers the bigger payment. That's the hard part. And that's the part nobody sells you a course on. This one's reachable, by the way. Not billionaire territory. People with a lot less than you'd guess do exactly this. Now the one behind every headline about a billionaire paying almost no income tax. It's not a loophole somebody snuck in. It's 3 ordinary rules stacked on each other. And once you see it, you can't unsee it. Step 1. Buy. You own things that go up. Stocks, property, a business. Gains on paper aren't taxed. You only owe when you sell. So rule 1 is, don't sell. But you still need money to live on. So step 2, borrow. You go to a brokerage and borrow against the portfolio. It's a real product called a securities-backed line of credit. And you pledge your holdings as collateral. Numbers, say you've got $4 million in stock you bought for $800,000. That's a $3.2 million gain. Sell it. And long-term capital gains tops out at 23.8% once you include the investment income surtax, $761,000 gone. Borrow $400,000 against it instead. Rates on these run about 5 to 7.25%, depending on your broker and how big the line is. Call it 6.75. That's $27,000 a year. You could pay that interest for 28 years before it adds up to the tax bill you skipped. That's the trade. Rent money at 7 to avoid handing over 24. One thing I want to correct, because the version of this going around says your assets grow 7% while the loan costs 6, so you're making money on the spread too. That's not true right now. 7% growth against a 6.75% loan is a spread of 1/4%. Basically nothing. In 2021, when money was nearly free, this was a double win. Today, the money is made entirely on the tax side, and that's still enormous. Then step 3. Die. Your heirs inherit at what's called stepped-up basis. The cost basis resets to market value on the day you died. Every dollar of gain you never paid tax on just disappears. The kids get the stock, the loan gets settled from the estate, and a lifetime of growth is never taxed at all. Government estimates put the cost of that one rule at around $40 billion a year. And before you assume the estate tax catches it, the 2026 exemption is $15 million per person, $30 million for a couple, and it was made permanent last year. So for nearly everyone running this, the last step is clean too. Straight with you. This one isn't for you today. Most firms want 6 figures in a taxable account before they'll even open the line, and realistically, a lot more. But you needed to see it, because the small version is 2 minutes away. That line of credit is the engine underneath the last one, and there's a smaller version of it that ordinary investors use all the time. Worth understanding both what it does and where it bites. You borrow somewhere between 50 and 95% of your portfolio's value, depending on what you hold. You don't sell, so you don't trigger tax, and you don't step out of the market. Rates are usually well below a personal loan or a card, because it's fully secured. People use it to buy a car, cover a tax bill, or bridge a house purchase without liquidating anything. That's the upside, and it's a genuine one. Here's the cost of getting it wrong. Say you've got 200,000 of your own, and you borrow another 100. So you're running 300,000. Market drops 30%. Your 300 is now 210. You still owe 100. Your own money is 110,000. If you'd never borrowed, that same 30% drop leaves you with 140. A 30% move just took 45% of your money. That's the same multiplication that made you money on the way up, running backwards. And if the collateral drops far enough, the lender can demand cash immediately or sell your holdings to cover it. That's a margin call. At half your own money and half borrowed, you'd need something like a 50% crash before anyone rings. But most people who blow up weren't at 50%. They were at 80 or 90, where a 5% wobble triggers the call and you get sold out at the bottom of a dip that recovers 3 weeks later. There's one version that's worse than all of it, and I'm mentioning it so you can recognize it and walk away. Short selling. You borrow a share instead of money, sell it immediately, and hope it drops so you can buy it back cheaper. Buy a stock, and the worst case is it goes to zero. You lose what you put in and it stops. Short one, and there's no ceiling. Short 100 shares at $30. That's 3,000. Stock runs to 180. You have to buy them back at 18,000. 15,000 lost on a $3,000 position, 500%, and it could have kept going. Same equation, negative, with nothing underneath it. Now the one you can run this week. It's the small version of the kitchen fitter, except instead of a supplier lending you cabinets, a credit card company lends you cash at 0%, balance transfer offers. First correction. You'll hear these run 18 to 21 months as standard. They don't. The average balance transfer offer right now is 0% for about 13 months. 21 exists. That's roughly the best card on the market, but you need good credit for it. Plan around 13. Treat 21 as a bonus. There's a fee, usually 3% upfront, sometimes 5%. Run the number. You're renting money for 3% for over a year. Anything you do with it that beats 3%, you keep. And the best use of it isn't clever at all. It's this. Say you're carrying $8,000 on a card. The average rate on a new card offer right now is 23.79%. That's about $1,900 a year in interest for nothing. Move it to a 0% card. The fee is $240. Over 13 months, you avoid about $2,060 in interest. You're up $1,800. Get the 21-month card, and you're up over $3,000. That's a guaranteed, market-proof return that beats almost any investment you could name, and it's available to most people watching this today. One condition, and it's the whole thing. You have to clear the balance before the promo ends. $8,000 over 21 months is $381 a month. Set that up as a standing payment on day one. If you don't, the rate snaps back into the 20s, and you've paid a fee to delay the problem. Same mechanism as the kitchen fitter. Borrow cheap, put it to work, keep the difference. The only thing between you and him is the size of the number. Last one, and everybody can move this one starting today. Look at the number again. The spread is what the money earns minus what the money costs. Everyone obsesses over the earning half. The cost half is the one you can negotiate. And every point you knock off goes straight into your pocket on every loan you ever take for the rest of your life. Your credit score sets what your money costs. The national average FICO is 714 right now, and it just fell for the second year running, mostly because student loan delinquencies started getting reported again. Now, one more correction. People say the gap between a fair score and an excellent one is worth several percentage points on every loan. On a mortgage, that's not what the data shows. In July, borrowers at FICO 740 or better locked 30-year mortgages, averaging 6.61%. Under 680, same deposit, averaged 6.84. A gap of 0.23 points on a $400,000 loan, that's $61 a month. About $22,000 over the life of it. $22,000 for fixing a number on a report is a fantastic trade. It's just not several percentage points. Where your score genuinely is worth several points is credit cards and car loans. Excellent credit gets you around 17% on a card. Poor credit gets 30 or more. That's a 13-point swing on the exact debt most people are actually carrying. So point your effort there. Same advice, better reason, and you'll know which wins are big. So what can you actually go and do? Start with the cost side, because it's free. Pull your score this week and find out what your money costs you. Then the balance transfer. If you're carrying a balance at 23%, you're on the wrong side of the spread. You're the one lending to them. Flip it, pay 3% instead of 23, and keep the difference. And if you sell anything or run anything, take the deposit before you buy the materials. Use the 30 days your supplier gives you. Every time you do, less of your own money is in the deal, and more of what you make is pure return. Then run the number on whatever's in front of you. For every dollar of yours that's in it, how many dollars are you controlling? And does what they earn beat what they cost? The billionaire with the line of credit and you with a balance transfer are doing the same arithmetic. All that changes is the size and which direction it's pointing. One line for the whole video. Debt is rented money, and the only question that's ever mattered is whether what you do with it earns more than the rent. Get that on the right side, and debt stops being the thing that owns you. Money decisions made clear. See you in the next one.